Hello everyone, and welcome back. Today we're going to battle against one of the biggest financial burdens in your life, your mortgage. If you are listening to this, you probably have a 30-year loan hanging over your head. It's that subtle pressure you feel when you wake up in the morning. It's the reason you stay in a job you might not love. It's the subscription to life that you can't cancel. Most of us just accept it. We sign the papers, we set up the direct debit, and we forget about it. But have you ever actually done the math? If you take out a standard $500,000 loan in Australia with an average variable rate of around 5% over 30 years, do you know what you're actually paying back? You are essentially buying one house for yourself and buying a second house for the bank. The banks love this. They rely on your apathy. But today I'm going to share 9 specific, actionable strategies, some logical, some psychological, and some that are frankly just playing the game better than the banks do, that can help you pay off that loan in 10 years instead of 30. We're talking about saving potentially $200,000 or more in interest. I've gone through the data. I've looked at the banking system from the inside out, and I'm going to tell you the things your bank manager definitely won't. So buckle up. Let's get you debt-free. The reality of the banking system. Before we get into the tactics, we need to understand the battlefield. Why doesn't the bank tell you how to pay them off faster? It's simple economics. Your interest payment is their revenue. If you walk into a branch and ask, should I fix my rate? Should I use an offset account? You're not going to get an objective answer. Why? 1. Bank employees are not financial advisors. Legally, they can't give you personal financial advice. 2. They often don't understand the complex mechanisms themselves. 3. And this is the big one, their advice conflicts with their profit margin. Banks are designed for short-term shareholder value. The managers have KPIs based on loan volume, not loan reduction. They rotate every 3 to 5 years. They don't care if you're debt-free in 2035. They care if they hit their bonus target in 2025. This leads us to a concept known as the loyalty tax. If you have been with the same bank for 5 years, patting yourself on the back for being a loyal customer, I have bad news for you. You're likely paying a higher interest rate than the guy who walked in off the street yesterday. Banks offer the gold-plated deals to acquire customers, not to keep them. Understanding this hostility, or at least this misalignment of interests, is step 1. Now, let's get into the solutions. The power of the switch, refinancing. This brings us to our first major strategic refinancing. The smartest property investors I know do not stay with one bank for 30 years. They move. Every 2 to 3 years, like clockwork. Why 2 to 3 years? Because the market changes. A new lender enters the market and wants to grab market share. They offer lower rates, better terms, and often cashback incentives, sometimes thousands of dollars just for switching. But here is the psychological trick. If you call your current bank and say, hey, can I have a lower rate? They might ignore you. They know it's a hassle to switch. However, the moment you get approved by a new bank and submit a discharge form to your old bank, the dynamic flips. Suddenly, you are routed to the retention team. Now, they have the authority to negotiate. They might match the rate or offer you a credit to stay. But you only get that leverage if you're willing to walk away. So the rule of thumb, review your loan every 24 months. If you aren't refinancing or renegotiating, you are voluntarily paying the loyalty tax. The broker and the banker. I want to jump to the top of the list for a moment because this facilitates everything else. Who is helping you execute this refinancing strategy? This strategy is choosing the right partner. You have 2 choices, a bank manager or a mortgage broker. If you're extremely wealthy, I'm talking business revenues in the tens of millions, go to the bank manager. They will roll out the red carpet because they want your business accounts. You'll get bespoke service. But for the 99% of us, salary earners, small business owners, regular investors, you need a mortgage broker. Here is the difference. A bank employee works for the bank. They sell their products. It's like walking into a Toyota dealership and asking if you should buy a Honda. They aren't going to help you. A broker works for you. They can scan 30, 40 lenders to find that specific product that fits your needs. But you have to be careful. Not all brokers are created equal. Some brokers are lazy. They have 2 or 3 banks they like because the software is easy to use, so they dump all their clients there. Some brokers only understand basic PAYG salary employees. If you're self-employed, have a trust structure, or complex investments, a basic broker will crash your application. And here is a little industry secret regarding brokers, the clawback. Brokers get paid an upfront commission by the bank when they sign you up and a small trail commission for every month you stay. If you leave that bank within 2 years, the broker often has to pay back that upfront commission to the bank. This is why, if you ask a broker to refinance you after 12 months, they might seem hesitant. It's coming out of their pocket. This explains why the 2-year cycle is standard in the industry. It aligns your need for a new rate with the broker's protection from clawbacks. So, find a broker who understands strategy, not just data entry. Ask them, do you understand tax deductibility? Do you work with investors? Can you structure this for future growth? The magic of the 100% offset account. Now let's get into the technical mechanics of the loan itself. This strategy is using a 100% offset account. If you have a variable rate loan and you do not have an offset account, you are literally throwing money away. Here's how it works. A standard mortgage charges interest on the full balance. You owe $500,000. You pay interest on $500,000. An offset account is a transaction account linked to your mortgage. If you have $50,000 sitting in that account, the bank subtracts that from your loan balance before calculating interest. So, $500,000 minus $50,000 equals $450,000. You are only paying interest on $450,000, but the money is still yours. It's not locked away. If you need it for an emergency, you pull out. The key phrase here is 100% offset. Some shoddy loan products only offer partial offset. Avoid those. You want every single dollar in your savings account effectively working to reduce your mortgage interest every single night. Salary direct crediting. This strategy is a simple behavior change. Have your salary paid directly into your offset account. Many people have a separate spending account and a savings account. They get paid into the spending account, and maybe at the end of the month, they transfer leftovers to the mortgage. Wrong. Do it backwards. Mortgage interest is calculated daily. Let me repeat that. Daily. If your salary of $5,000 hits your offset account on the first of the month, and you spend it slowly over the next 30 days, that $5,000 is reducing your interest bill for every single day it sits there. Even if you spend it all by the 30th, the fact that it was sitting there for a few weeks saved you money. Treat your offset account as your main day-to-day transaction account. Every dollar you earn, salary, bonuses, tax refunds, goes in there immediately. Let it sit there as long as possible before it leaves. The credit card arbitrage. Now, I know some of you are going to hate this next one because we've been taught that credit cards are evil. And if you have no self-control, they are. But if you are disciplined, strategy number 6 is a weapon. Use a credit card for living expenses. Wait, didn't I just say pay off debt? Yes. But remember the offset account logic. We want our cash sitting in the offset account for as long as possible to reduce the daily interest calculation. If you pay for groceries with your debit card, offset card, that money leaves your account immediately. The interest saving power is gone. However, if you put that grocery bill on a credit card, the bank's money pays for it. Most cards have an interest-free period of up to 45 or 55 days. You're using the bank's money for free for nearly 2 months. Meanwhile, your cash is still sitting in your offset account, suppressing your mortgage interest. Then, on the very last day before the credit card interest hits, you set up an auto sweep to pay the full balance from the offset account. You pay 0 credit card interest, you earn points or airline miles, and you've kept thousands of dollars in your offset account for an extra 45 days, lowering your home loan interest. It's a specialized form of arbitrage. But warning, if you miss one payment, the high interest rates will wipe out your savings. This is for the disciplined only. The frequency hack, fortnightly payments. Let's talk about the calendar. This strategy is the easiest set and forget method to shave years off your loan. Change your repayment frequency to fortnightly. Most banks default you to monthly repayments. It makes sense, right? 12 months in a year. But if you switch to fortnightly, you pay half the monthly amount every 2 weeks. Here is the trick. There are 26 fortnights in a year. 26 divided by 2 is 13. By paying fortnightly, you are accidentally making 13 months of repayments every year instead of 12. You won't even feel the difference in your budget, but that extra month's worth of principal payment goes straight to reducing the debt. Also, because you're paying more frequently, the principal balance drops faster, which means, again, less daily interest is calculated. The math on this is startling. On a typical 30-year loan, just doing this one switch can save you about 4 years and tens of thousands of dollars in interest, just by changing a setting in your internet banking. Crucial note, be careful. Some banks calculate fortnightly by just taking the annual cost and dividing by 26. That doesn't help you pay extra. You want to take the monthly amount, divide it by 2, and pay that every fortnight. Make sure your broker sets it up correctly. The latte factor, paying extra. This strategy is obvious, but rarely executed well. Pay a little bit extra. I'm not talking about starving yourself, but look at the math. On a $500,000 loan, adding just $100 extra per month, that's $25 a week or literally 4 coffees, can cut 2 years off your loan. If you can stretch that to $1,000 extra a month, you could be done in 17 years instead of 30. The earlier you do this, the better. Extra payments made in the first 5 years of a loan are exponentially more powerful than payments made in the last 5 years because you're killing the compound interest before it has a chance to grow. This requires a look at your lifestyle. Luxury goods, expensive cars, these are depreciating assets. They lose value. Your mortgage is a cost that gains interest. Divert money from the loss column to the debt destruction column. Lazy money and diligent money. This leads us to a philosophical question. Should you always pay off the mortgage? This strategy is about effective use of funds. Think of money as an employee. You have lazy money and diligent money. Lazy money sits in a standard bank account earning 0.1% interest. That's terrible. Diligent money is working hard for you. If your mortgage interest rate is 6%, then every dollar you put into your offset account earns you a guaranteed, risk-free, tax-free return of 6%. That is actually very hard to beat in the stock market consistently once you factor in tax. However, if you're a sophisticated investor, you might find that investing that extra cash into another property or a high-growth business yields 10%, 15%, or 20%. In the Australian market, property has historically grown at around 7% per year. Plus, you get leverage. A 7% growth on a $1 million asset is $70,000. That might outweigh the interest you save on your home loan. So, the strategy here is don't just blindly pay off debt if you can make significantly more money elsewhere. But for most conservative people, the offset account is the safest, best guaranteed return you will find. The tax game. Now, let's talk about the government. This strategy is tax arrangement. If you can legally reduce your tax bill, that is free money you can throw at your mortgage. If you have an investment property, are you maximizing your deductions? Are you claiming depreciation? If your investment property is relatively new or you've renovated, you can hire a quantity surveyor to write a depreciation schedule. This is a paper loss that reduces your taxable income, potentially resulting in a tax refund of thousands of dollars. Take that tax refund and dump it straight into your home loan, not your investment loan. Always pay off your home loan first. The interest on your home is not tax deductible. The interest on your investment property is tax deductible. Therefore, the home loan is bad debt, and the investment loan is good debt. Prioritize killing the bad debt. Talk to an accountant. If you aren't doing this, you're leaving money on the table. The broker's secret sauce. I want to circle back to where we started, the broker and the bank, because there's a layer of nuance here that I missed. Top-tier brokers, the ones who handle millions in transactions, operate differently. They know which banks are currently hungry. Sometimes a major bank falls behind on its quarterly targets and quietly releases a great offer that isn't advertised on TV. Only brokers know about this. They also know how to structure loans to protect your credit score. If you go around applying to 5 different banks yourself, your credit file looks like you are desperate. Your credit score drops and you get rejected. A broker knows how to shop around without leaving a footprint that damages your reputation. Furthermore, a great broker is a lifelong partner. They shouldn't just talk to you when you buy the house. They should be calling you every year to say, hey, I notice your rate is 0.5% higher than the market average. Let's call the bank and threaten to leave. If your broker isn't doing that, fire them. Conclusion: it's about freedom, not just numbers. So, let's recap the arsenal we've built today. Refinance regularly. Don't pay the loyalty tax. Move every 2 to 3 years. Use a 100% offset account. Make every dollar reduce your interest. Salary crediting. Direct all income to the offset immediately. Credit cards. If you're disciplined, use the bank's money for living expenses to keep your cash offsetting interest longer. Fortnightly payments. The hidden 13th month payment. Pay extra. Even small amounts destroy compound interest early on. Invest wisely. Weigh the return of paying off debt and investing in growth assets. Tax optimization. Maximize refunds through depreciation and apply them to the mortgage. Get a pro. Use a high-quality broker, not a bank employee. Why do we do this? It's not just to see a zero on a bank statement. It's because when you don't have a mortgage, you have choices. You can quit the toxic job. You can start that business you've been dreaming of. You can travel. You can retire early. The bank wants you on a hamster wheel for 30 years. They built the system to keep you there. They rely on you being passive, confused, and loyal. Don't be loyal to a bank. Be loyal to your future self. Take one of these strategies, just one, and implement it this week. Call your broker. Switch your payment frequency. Open that offset account. The clock is ticking, but if you play it right, it's counting down much faster than the bank expects. Thanks for listening, and see you next time.